Thank you, Mr. Chairman. Got a great panel today. Congratulations on putting this together. Mr. Holtz-Eakin, let me start with you. In testimony before the Banking Committee, which I sat on, and Ms. Velasquez does as well, Vice Chairman Barr, whose proposal is basically this Basel proposal, has responded to the question from me personally, have you had an economic analysis of this? Said no. So I think your answer is correct. I don't know where she's getting her information from, but even the Fed Vice Chair of Regulations who proposed the rule said there is no economic analysis, which is horrible from the standpoint of proposing rules and understanding the effect on this economy. Reminds me of the old debate about Cecil. Not that you want to go there, but anyway. Mr. Holtz-Eakin, this Basel proposal, in my mind, is a disaster from the standpoint. We just come through the COVID situation, and our banks performed admirably. Had a little hiccup this last spring, but that was their own fault, not because of the economy. So I would just like your opinion on this rule as a former banker and a former regulator. When they say that this is only going to affect the top group of banks, these things roll downhill. Even your community banks, at some point, the regulators are going to sort of wink and nod and say, "This is a really good idea. You need to be implementing this." What's your thought process on this rule and its effects on capital access by the small business?
So, the financial markets are by definition interconnected. And so to impose these capital requirements, suppose you say like the operations risk, my discontent with the proposed rule is there's no quantification of how large is operations risk. There's no quantification of the benefits to holding particular amounts of capital against operations risks. It's just hold this and we'll assign it to operations risk. I think they could do a better job in defending the proposal. Costs are costs. That's not going to be confined to operations. They're going to have to raise the revenue to cover those costs. That means all credit will get more expensive. This is going to get embedded across those banks' pricing structures, and the smaller banks often rely on larger banks for funding needs of various maturities, and it'll spill over to the smaller banks. You cannot isolate it in just the largest banks. They also extended it beyond what Basel III required them to affect regional banks in ways that I did not understand and don't address Silicon Valley or Signature or any of the things that went on. And so this is an implementation of Basel III that doesn't hew to the necessary implementation. It has a lot of new undocumented capital requirements that are costly, but without demonstrated benefits, and it will affect the entire financial sector.
Thank you for that. And I appreciate your comment with regards to about $150 billion worth of new rules and regulations of cost compliance each year. That's a huge driver of inflation when you add that as a cost that has to be embedded into the price of the products and services, especially a small business. Mr. O'Leary, thank you for being here. Great to see you again. This morning I saw an article that said there's about $8.8 trillion in CDs and money market funds that's available and probably going to shift to the equities market as a result of interest rates coming down. That is both wonderful and not so hot at the same time. It's a two-edged sword. It's a bad deal from the standpoint that those dollars, a lot of those dollars are there for the banks to be able to loan money to small businesses. If those flow out, that means they have fewer dollars to invest. But it's also a good deal from the standpoint there may be some more venture capital dollars available for small business. Would you give me your opinion on that, please?
First of all, the assumption that interest rates are going down, I'm not so sure. As we all know, the Fed mandate is 2% inflation, not 2.5, not 3, not 3.2. I assume they'll stay the course at 5.5 terminal rate until they actually see 2% in sight, which is nowhere near in sight for a whole bunch of infrastructure reasons. In addition to a lot of new capital coming, fresh capital, I call it helicopter money from infrastructure, chips and science, and from IRA. That's inflationary. I know we called it the Inflation Reduction Act. Anytime you print money, it's inflationary, period. There's no other way to interpret it. And so I think that's the pressure. It's sucking and blowing at the same time, a bit of a problem. But it's been 2 generations of people that have never seen money in a bank or in a short-term CD or a short-term treasury make over 5%. And now they've seen it for the first time. The market gives you 7 to 9% over a long period of time. And so some portion of that money is going to stay exactly where it is because the typical portfolio pre-pandemic was kind of 60% equity, 40% fixed income, of which now Treasury is very attractive. So I would agree with you. There's going to be some pressure in terms of keeping that capital in a form that banks can lend it out. But I have to speak to this Basel III issue from a different perspective. It's bad policy, and here's why. Today, our banks, the money center banks, compete with New York, Zurich, and Abu Dhabi.
Gentleman's
Those are the
time is
other.
up.
Sorry.
Thank you.